Hello guys, my name is Cesar, and today I'm going to talk about the basics of an inventory system. First off, we are going to see the definition of an inventory, also the types such as raw material, work in progress, and finished goods. As well, inventory methods such as FIFO, first in, first out, LIFO, last in, first out, and the ABC method. As well, we're going to talk about the importance of an inventory system, bad management, good management, and their outcomes. What's an inventory? Inventory is the raw material work in process, products, and finished goods that are considered to be portion of a business assets that are ready or will be ready for sale. Inventory represents one of the most important assets of a business because the turnover of inventory represents one of the primary sources of revenue generation and subsequent earnings for the company's shareholders. Okay, in this section we are going to explain the types of an inventory such as raw material, work in progress, and finished goods. First off, we're going to talk about raw materials. This represents goods that are used in the production as a source material. Examples of raw materials are metal bought by car manufacturers, food ingredients held by food preparation companies, and crude oil held by refineries. Also, we have work in process. Okay, these are goods that are in the process of being transformed during manufacturing and are about to be converted into finished goods. For example, a half-assembled airliner or a ship that is being built would be work in process. Also, we have finished goods. These are products that have gone through the production and ready for sale, such as complete airliners ready to ship, cars, and electronics. Some examples of merchandise include electronics, clothes, and cards held by retailers. Up next, we have an inventory methods, such as first in, first out, last in, last out, and the ABC method. First, we have FIFO, first in, first out, is an assessment, management, and valuation method in which the assets produced or acquired first are sold, used, or disposed of first, and might be used by individual or corporation. For taxation purposes, FIFO assumes that the assets that are remaining in inventory are matched to the assets that are most recently purchased or produced. An example of FIFO will be typical economic situations involve inflationary markets and rising prices. In this situation, if FIFO assigns the oldest cost to cost of goods sold, this oldest cost will be theoretically be priced lower than the most recent inventory purchase. At current inflated prices, this lower expense results in higher net income. In addition, because the newest inventory was purchased at generally higher prices, the ending inventory balance is inflated. On the other hand, we have LIFO, last in, first out. It's an asset management and valuation method that assumes assets produced or acquired last are the ones used, sold, or disposed of first. LIFO assumes an entity sells, uses, or disposes of its newest inventory first. If an asset is sold for less than it is acquired, then the difference is considered a capital loss. If an asset is sold for more than it is acquired, the difference is considered a capital gain. In this example of LIFO, okay, we have to assume company A has 10 widgets. The first 5 widgets cost $100 each and arrived 2 days ago. The last 5 widgets cost 200 each and arrived 1 day ago. Based on the LIFO method of inventory management, the last widgets in are the first ones to be sold. 7 widgets are sold. Based on the LIFO method, the last inventory in is the first inventory sold. This means the widgets that cost $200 sold first. LIFO creates higher cost and lowers net income, which also lowers taxable income. Likewise, in periods of falling prices, LIFO creates lower cost and increases net income, which also increases taxable income. And the third method will be ABC method. The ABC method approaches state that when reviewing inventory, a company should rate items from A to C, basing its ratings on the following rules. A items are goods which annual consumption value is the highest. The top 70 to 80% of the annual consumption value of the company typically accounts for only 10 to 20% of total inventory items. B items are the inner class items with a medium consumption value, those 15 to 25% of annual consumption. Value typically accounts for 30% of total inventory items. And the C items are, on the contrary, items with the lowest consumption value, the lower 5% of the annual consumption value, typically accounts for 50% of total inventory items. Here we have an example of the ABC method. The yearly sales distribution of a US e-commerce in 2011 for all products that have been sold at least once, products that are ranked starting with the highest sales volumes out of 17,000 references. Top 2,500 products, top 15% represents 70% of the sales A, which is product A. The next 4,000 products next to 25% represents 20% of the sales, which are going to be the ranked B items. Bottom, we have 10,500 products. Okay, bottom 60% represents 10% of the sales, which falls into the C category. Importance of inventory. In this section, we have consequences of having a bad management system. Remember that not having enough inventory means you run the risk of losing sales, while having too much inventory is costly in more ways than one. That's why having an effective inventory control system is so important to avoid stockouts, overstock, and capital issues. An inventory stockout. Okay, one of the worst things you can do in business is to turn away customers, people who are ready to give you their money because you've run out of items they want. Stockouts not only cost you money from missed sales, they can also make you lose customers for good, as people resolve to take their business somewhere that can satisfy their needs. An efficient inventory control system tracks how much product you have in stock and forecasts how long your supplies will last based on sales activity. This allows you to place orders far enough ahead. On the other hand, we have an overstock. Okay, when inventory isn't managed well, you can also wind up with overstock. Too much of certain items, overstock comes with its own set of problems. The longer an item sits unsold in inventory, the greater the chance it will never sell at all, meaning you'll have to write it off or at least discount it deeply. In the worst case, of bad management systems are capital issues. Keep in mind that inventory is expensive to acquire. When you pay, say, 15 for an item from a supplier, you do so with an expectation that you will soon sell that item for a higher price, allowing you to recoup the cost plus some profit. As long as the item sits on a shelf, okay, dot, its value, it's locked up in inventory, that's $15 you can use elsewhere in your business. So why is it so important to have a good inventory system? Remember that processing a high amount of inventory for a long time is usually not advantage for a business because of costly storage, the possibility of obsolescence, and spoiled cost. However, possessing too little inventory is beneficial either since the business runs the risk of losing out on potential sales and potential market share as well. Inventory management forecast and strategies such as just-in-time inventory system can help minimize inventory costs because goods are created or received only when needed. So inventory control isn't just about managing the stuff going in and out of your company. It's also about managing your working capital, keeping you from having too much precious cash tied up in operations. Also remember that a good inventory management strategy improves the accuracy of inventory orders, leads to a more organized warehouse, helps save time and money, increases efficiency and productivity, keeps your customers coming back for more. And remember that inventory constitutes one of the important items of current assets, which permits smooth operation of production and sales process of a firm. Inventory management is that aspect of current assets management which is concerned with maintaining optimum investment in inventory and applying effective control system so as to minimize the total inventory cost. This has been the basics of an inventory system. Hope this presentation is useful for you guys. Thank you for watching. Goodbye.